Well, welcome everyone to the latest edition of the Raising Capital Seminar Series. Teresa, I was trying to remember how long we've been doing this now, but I think we're coming up on 4 or 5 years doing this twice a year. So welcome. Thank you all for coming today. Teresa, you want to drop to the next slide? So we actually have a 5-module set of information for all of you. This is module 1. This really is an overview of the journey. We got somebody out there. We need some people. Okay, I guess the first rule is mute your mic. Sorry, we had some people talking over. So just if you all could just make sure your mic is muted. Please leave your camera on if you're willing. We'd love to see all of you. So that would be great. So just saying we're on the very first of the 5 modules, the journey, and this is really meant to be an overview of the process. We get really focused on pitch decks and financials and all those kinds of things, but there's so many other things that are important to the process of raising capital. So next slide, Shrees. Shrees, do you want to introduce yourself? I'm not reading all that, Shrees.
My least favorite part, right? Talking about myself. I'll just give you a quick background. I spent over 5 years as a co-leader of Dwala, as the chief operating officer there. Helped the company scale from 2 people to 80 plus people. During my time there, raised over 32 million in venture capital from firms like Andreessen Horowitz, Union Square Ventures, and several strategic investors. Moved to San Francisco and was really part of the tech scene out there during my time of co-leading Dwala. And then over the last 4 or 5 years, I've been helping entrepreneurs raise venture capital. Mike, I used to keep track of this number, but I think it's probably over like 100 million that I've helped local entrepreneurs, part of this ecosystem, raise venture capital over the last 5 years. So still intimately involved in how do you prepare to raise, how do you strategically go through that process, spend a lot of time with people on preparing the pitch deck, all the materials in order to raise, and then guiding them through kind of I got this response from an investor, what are your thoughts on how to react? So that's a little bit of my background. I do a fair amount of also facilitation for Drake's leadership and supervisory management program. I never really intended to be a consultant. People just keep calling, and frankly, it works really well. I have 2 young kids, and so it's a nice change of pace right now. Several of the clients I help, they're like, join my company. I'm like, I just don't have the working 80 hours a week in my life right now, but maybe someday. So entrepreneur at heart, don't plan on being a consultant forever. But I feel very fortunate that I'm able to leverage my experience and help others right now. And as Mike said, we've been doing this together for 4 or 5 years, presenting this seminar.
Yep. I don't have a slide in here. I do teach the 3rd module, but I'm Mike Caldwell. I recently retired from the Greater Des Moines Partnership. I actually now live in Fort Collins, so I'm up a little earlier than many of you are perhaps, but the partnership has been involved heavily in the scene for 14 years in the ecosystem in Central Iowa and beyond. And they are kind of the instigator of all of this. And there's actually a new person that's going to be announced very, very soon. It's going to be picking up, I hope, where I left off and doing even more than what I was able to help accomplish. So this whole seminar series is a joint collaboration with 3 groups: the partnership, which is a regional economic development group; LWBJ Capital Advisors, or I call them Capital Advisors. They do a lot of different things, but they have a capital advisory group, which is basically an M&A practice. They've helped a lot of the companies in Central Iowa and honestly with them throughout the Midwest, raising capital, buying companies, selling companies, typical M&A work. And then BrownWinick Law, they actually are going to be teaching one of the modules on term sheets. LWBJ will be teaching the cap table section, which is really important because cap tables can be challenging. BrownWinick's just been really, really friendly to the entrepreneurs in the ecosystem. I would say they are now kind of the leaders of doing the early stage legal work around high growth potential startups. So with that, next slide. So yeah, logistics, mute your microphone. Please keep your video on. Please ask questions. Sharice and I do not like sitting talking to a computer screen. We would much rather have a conversation. One of the ways you can do that is just jump in that chat room. Please open the chat up. It's a great place to type a question. I'm going to be in the middle of this as well, kind of asking some questions. I got a few small pieces that I teach, but mostly this will be Sharice today. We are recording this and it will be made available after the fact, as will all the slides, all the documents, appendices. I think we've got pretty much everything on the appendix now live linked, so you can just grab the link as you go. So let's see, next slide. Okay, so these are the 5 modules. So this is the overview, and we're going to be really talking about all the pieces and parts as a whole, but getting into some detail in certain areas. And then from there, we go into the 4 of the deep dive areas. So the pitch, and there's a lot of art to pitching. There's not much science. Different things work for different people and different investors, but I think that what you'll find in this session is really a good overview of what has worked in the past, what's working now, and some guidelines to work with, because there's no perfect way to do it. Module 3 is the one that I teach. It's on building strong financial models. Some of you on this call, I think, have already been involved in that through the GIA, but this really gets into the nuts and bolts of modeling both software and hardware type businesses. Module 4 is on the cap table. Who owns your company? And really deeply understanding what it means to take investment dollars and how you keep track of who owns how much of your company and what that means with that hopeful exit that you will have someday. And then module 5, the final module, is the term sheet itself, which is the whole process. It's the dance or the dating process around the actual capital raise, where you define exactly the terms of how you'll accept money, what you will give up for it as a founder, what your investors will receive for it, what the investors are allowed to ask you and drive you crazy with, and what you don't have to worry about, those kinds of things. So really that's the seminar. I think most of you found this through the link we provided. You can, I believe the same link is good for all 5 sessions, but just refer back to the emails you've received for links going forward. And you're welcome to join us for all the sessions that you wish to join. Sharice, I think that's my section.
All right. Thank you, Mike. Good morning again, everyone. It's nice to see some familiar faces, and I also look forward to the opportunity to get to know more of you. I'm just going to start with that a little, getting to know where everyone is at. Maybe a raise of hands. How many of you is this your first startup? Okay, several of you. How many of you have raised any sort of venture capital or angel capital before? A couple of you. Okay, so most of this will be pretty new. That's good to know. And then maybe one more raise of hands. Who is looking to raise, I don't know, I would say between $0 and $1 million in the next 12 months? 0. So kind of that first stage. Anyone looking to raise over $1 million in the next 12 months? A couple of you. Okay. That will be helpful. I will try to kind of moderate between, that seed and that kind of A stage. But certainly know that as Mike and I were putting this together, it was really interesting because I had come from almost my brain was in C stage of how do you raise $20-30 million? And then, over the years, we've kind of backed this up and realized that a lot of the participants who join us on this journey are, more in that seed stage. So the content here will cover, all of those stages, but that's really where the questions and that you guys participating in this workshop add the most value, because there's nuances along all of those stages. And so just ask questions, don't feel like anything is dumb. Some of the most obvious questions really lead to the most fruitful conversation. So interrupt me or use the chat, however you prefer. So as we think about the fundraising journey, what I try to do is think about a framework. If I was to think about the themes that I had to keep in mind during fundraising, what were those components? What were the things I had to keep going back to? And I kind of came up with the 3 M's of fundraising. It was really important to have momentum. And that was both prior to the raise, during the raise, and after the raise. Materials, all the things that had to be created in order to talk to investors, to get through due diligence, etc. So we'll be diving deep into all of these. And then meetings, the just the amount of time it took to do networking, to do pitch practices, to formally pitch investors, and then the ongoing follow-up. So if you were only to keep 3 things in mind, like what do I need to do when I fundraise? The 3 M's, if you can come back to that, like what is the momentum I'm keeping going? What are the materials that I'm continuing to iterate? And what are the meetings that I'm continuing to stay on top of? And really all 3 of those areas need to be what I call managed at the same time. You can't just focus completely on your product and sales and, haphazardly work on materials. The materials have to reflect the momentum that continues to happen in your startup. You can't put all the momentum, you can't put your startup on hold and jump all into just talking to investors. All of those things have to be kind of continued to push throughout the journey, which can be quite challenging. I would love if this was very linear, right? You prepare, you execute, and you manage. And the reality of fundraising is there's, really high highs, there's really low lows. You think you're already to like managing the close, and then all of a sudden you have to go all the way back to, rebuilding relationships because maybe something doesn't fall through. And maybe having that headspace going into it would be helpful, especially for those that are very linear, that just be prepared a little bit to what I call like run a process, but be prepared for the chaos. Because rarely do I see this like perfectly play out, unfortunately, because we're all humans and we don't control other people. So as much as you can kind of control the process, it gets a little messy sometimes. So I'm just going to pause here. I see a question come in. Thank you, Linda. So regarding fundraising, given the range you provide, 0 to 1 million, where would you place the 1.5 million raise? Would you raise 1 million first as a seed? Great question, Linda. We are absolutely going to talk about this a little bit later on. I would just ask you to hold me accountable. If halfway through this presentation we don't answer your question, make sure that I am. But there's some very specific parts on how much do I raise, how do I go about it, what do I call it. So we will be addressing that later on today. Thank you. So as far as what that kind of process looks like, Mike had said, if you were to build a project plan around fundraising, what would it look like? And I think my first response, Mike, is like, well, it's not really a linear process. I don't think you can just build here's my project plan, this is how I'm going to do it. But I tried to say, okay, these are the buckets of areas that going into fundraising, I wish I would have had a framework to know. Frankly, I was just kind of putting one foot in front of the other going through fundraising and hadn't really taken a step back and been like, well, what is the process? And I think the more I fundraised, I really realized that the more you run it like a process, the quicker it goes, the more successful it will be. But you'll see here kind of the buckets. I would say before you should really even think about fundraising, you need to be at a point of having some sort of momentum in your startup. And that can look like a lot of different things depending on what stage you are. Early on, that might be product traction. That might be customer validation. That might be that you have a lot of brand awareness, sales traction, et cetera. Those can be different things. So depending on what stage you are, but things should have some momentum there. Building investor relationships. I think this one sometimes is underestimated in just the amount of time it takes to build relationships with investors. Your fundraise is going to take a lot more time if you haven't already built relationships prior to wanting to raise money. So the more you can be out there building relationships and being very clear with investors of, I'd love to talk to you about my startup. I'm not raising money now or yet, but I want to get to know you so that when I am raising money, we've already kind of established a relationship. So the more you can do that, I think the faster your fundraising can go because you already have a group of people that are familiar with you and you can call upon.
Therese, can I drop a thought in there?
Yeah, go for it, Mike.
I think that Therese said something that's really important. Most investors don't want to have the first meeting with you when you're ready to raise funding. They want to have a first meeting with you far in advance, especially professional investors. If you're talking about seed funds, small VC groups, they usually are looking to get to know you over time. And one of the real values you can get out of that, because it's not just, smile and dial here, hi, my name is, it's ask questions. I found a lot of benefit in just, when someone says, well, how much should I raise and what do you think? I find a lot of benefit of asking investors that, potential investors that, just to get a feel for what they're thinking. It tells me about what kind of investor are they. There are two schools of thought, more than two schools, but one school is raise only what you need to go through the first 18 months, and the other school is raise as much as you can, right? Well, it helps to know which kind of investor you're talking to. So use that early on, and as you have questions, I was teaching a class the other day on financial modeling. We got into valuation scenarios on a fairly complex model. And I made the comment to fair, call up a couple of investors and just ask them. I mean, even cold call to say, look, I'm not raising yet. Might be someday. I see on your site you do SaaS-based models or whatever. Can you give me your thoughts on this? And it's a great way to start a conversation where they're not beholding and feeling like, oh, Therese is on the phone asking me for money. I got to put up my guard. Therese is going, no, I don't want money. I'm just hoping you'll give me help with a question.
Thanks, Mike. That was really helpful. Another thing is, it's as much as them getting to know you versus you getting to know them. And so I was much more likely to want to work with investor and have them, on my board when I'd already had the opportunity to informally kind of get to know them, over a 6-month period and see what kind of help they could bring, right? Were they just talking about all the help they could bring, or did they actually make introductions to potential customers, to potential strategic partners, et cetera, prior to even being on my board? You will find that investors have an incredible network and incredible knowledge, so they should be able to provide you value even before investing. Okay, so then another thing, several of these things will say iterative. The importance of like iterating on your pitch deck, working on that, practicing it. I was actually just talking to an entrepreneur the other day. He's like, okay, my deck's ready to go. I'm going to go call on these investors. And I said, hey, have you called anyone who's already invested and practiced your pitch, get their response? He's like, no, I hadn't thought about that. And so, the kind of the importance of iterating your deck, getting feedback prior to talking to that, number one investor that you're courting. Again, a lot of these things are iterative, working on your financial model, getting feedback on it. And you should be prepared. Once you start talking to investors, your deck will likely change 10, 15 times. Your financial model might change multiple times. So don't treat those things as kind of stagnant. Oh, my deck is done. My model's done. Now I'm ready to go. You'll likely be iterating on them quite a bit. Due diligence, that's kind of an ongoing process. And then your investor meetings, negotiation, et cetera. So as you think about the entire process, start to finish, this is sort of the components of it. And a lot of them are moving pieces. Fundraising, unfortunately, takes time, not only in the amount of like months, but the amount of time it will take from you and your business. And so being prepared for that. This is kind of a zoom in once you get past all that prep work. What does it even look like once you start pitching investors? And, there's different levels of your first pitch, your second pitch, your third conversation with them, what they might be asking for follow-up. So, you pitch them, they might start to ask to go through your revenue plan. They might want to understand, who are your competition, et cetera. So this kind of first level of diving in, and then like a deeper level of due diligence, where they might want to talk to your customers. They might want to dive deeper into your product roadmap. They might want to come sit with your tech team and go through your technology, make sure that it's a strong technology. Get even further into your customer deep dive. And I call this like pre-due diligence, even before they've given you a term sheet. The diligence that they're going to go through after they've given you a term sheet is even more. So then this you want to get out of this triangle of yes, no, maybe as fast as possible. Being in the maybe loop for too long can really kill your process, can just take too much time. So as you think about what are you trying to get to, you're trying to get them to a yes, no as quickly as possible. And so even asking them, once you give them a pitch, what does your process as an investor look like? Do you have a partner meeting? Do you have to convince other people in your group to write a check? Or can you, as a solo entrepreneur, make that decision here? How much deep diving into some of the stuff do you want to do before you give me a yes or no? And it's okay to push people to a no. I'd rather have them be in the no category than in the maybe forever category. It's just like think about it as a sales process, right? Someone constantly being kind of interested in you, but not buying, can ultimately be a huge time suck. The other thing to be aware of is some people get really, really short on cash, thinking like, I'm going to be able to get this fundraise done in a couple of months. What's going to happen if this drags out 6 months? What are you going to do from a cash perspective? And when do you start the fundraising process? Way too often I see entrepreneurs waiting too long and really getting in a really tough spot. And it takes their negotiating leverage away, because investors basically know, like, you're running out of cash, you're kind of desperate. So you're going to get like not as great terms if that's the case. So when I ask how many people will be raising money in the next 12 months, if it's like, I want cash in the bank in a year, I would really encourage you in the next probably 3-4 months to be ready from a pitch standpoint, to be starting to really garner those relationships, knowing that it's going to take, it could possibly take quite some time to raise those funds. All right, pausing there. Does anyone have any questions? Does this make sense to everyone? Okay, I'm seeing some yes, head shakes. Thank you. I appreciate you being on camera. It makes this a little more interactive. Okay. I got an indirect message or a direct message. So confidentiality agreements. Most investors won't sign an NDA, just like the way it is. They see so many pitches. They're just not in the business of signing NDA. So that can make some, I think, entrepreneurs feel a little uneasy. You might, if you really have a concept or something that, say you're developing and it's not even launched on your website, or there's no public knowledge about it, and you're really wanting to hold it close to the vest, you might just think about the way you're pitching and what information you share. You might think about what kind of investors you're talking to. In my opinion, professional investors aren't in the business of starting companies. They're in the business of investing. If you're talking to maybe someone who's more strategic and you feel like, oh, they could take my idea and do something with it, be aware of that. But at the end of the day, you as a company have to execute uniquely, have your technology unique. And so sharing with other people your idea, it's just really part of the process. And I know that can be very uncomfortable for some for some entrepreneurs, but it's really kind of the way it is. Mike, do you want to add on the NDA part?
Yeah, I really do. So, if as an investor, and I've been an active angel and by the way, Shreese is as well, for several years. And one of my first questions is, even whether you wanted an NDA or not, early in the process will be competition. And one of my favorite questions to ask people is, say, okay, you've got a team of 3 people, you're pretty motivated, you're really talented. What happens if a team of 10 people with 10 times as much money comes after you, how will you win? Because if you get a really great idea going and you really kind of create something new, believe me, big teams with big money will come after you. And so it has to be more than I'm first. I mean, being first is good, but you really have to be able to answer that question about what's going to make you unique and special. And there's a lot of ways to answer that, but it really is, I would say, a mark of maturity when you don't ask for that NDA and you just say, I always am worried about competition, but we feel like we're in a unique place, and this is why we are.
Thanks, Mike. There's another direct question around patents. So what are our thoughts around provisional patents and moving to a patent to cover the company? Mike, do you mind taking this one? I feel like you have a little deeper perspective on it.
Yeah, patents are great when you can get them. The problem with patents, so in the software space, that's hard to do. In the hardware space, it's very easy to do, but the question is defensibility. And in my previous company, we had over 800 issued patents. And we'd get someone come in that we had a very interesting patent. And they'd say, look, you're violating our IP and you need a license from us. And it's like, one of the first things we would do is look at what they're doing. And the answer was usually like, okay, we're not going to admit to it, but let's theoretically say we're violating some IP. We looked at in our portfolio, you're violating 11 of our patents. Okay, so suddenly you as a startup have lost all your leverage. So while patents are important, they are not a business model. And having a single patent will rarely, if ever, be a fully defensible position. You usually have to get patent attorneys involved. You have to build both an offense and a defense. As an example, we once sold a set of 8 patents on power managing a radio to Broadcom for something like $30 million. It's a crazy amount of money, but they used it to go win a $1 billion lawsuit against Qualcomm. So they were building a larger portfolio of patents to fight another patent. Patent battles, I rarely see anybody win in the long term. I think that there's some epic ones out there, but patents are important for keeping people kind of at bay, if you will, but they're not going to build you a business model. It's all about going to market and the customers loving what you do.
Yeah, as an entrepreneur, I would find the conversation around patents, frankly, very annoying. And the reason was everyone expects you to have them. And then at the same breath, they all say they're useless. So as an entrepreneur, when I think about how I wanted to spend my money, why would I spend money on something that's useless? But then if I didn't, like I was being kind of punished. Well, why don't you have a patent around that? So I would say, based on my experience, you have to have them. The word have is, you have to have them, but also realize that in some sense they're useless too. And that's not always the case, right? Like I work with one company that they have they're in like biotech. You absolutely have to have those. And I would say they're worth way more in biotech than they are in a SaaS-based company.
Yeah, and in fact, there's a person here on the call. I don't know if Kevin, if you want to chat at all, but Kevin actually licensed technology from a university that is very fundamental and very interesting and very unique. And it was a great way to start his company because he saw the problem and he saw a solution that was at the R stage. Kevin, I don't know if you can talk for a minute, if you're okay with that.
Sure. Yeah, it's really related to having a unique position with temperature and ambient temperature and ambient humidity for heat stress, heat stroke warning, and it's for all species, including humans. Ours is focused on dogs initially, so that patent we felt had value and uniqueness as we went to the next stage of market.
Thanks, Kevin.
I appreciate the conversations, everyone. Keep them coming. Okay, so let's talk about what stage you are in as a startup and what I say the typical expectations are. Know that there's always, you can always break these rules, but hopefully it gives you a good outline. So when you think about the pre-seed stage, this might be where you raise between 50 and 250,000. Typically, this would be a friends and family round. I don't see personally a lot of angels that you don't know investing this kind of early this small. Usually it's people you know. And usually the ownership is pretty small. It's typically less than 5% of the ownership. There's no board seat. Your team is really small. Product market fit, you're usually really, really early on, et cetera. A lot of founders are putting in their money and sweat equity at this point. Now let's move to kind of the seed stage. In my mind, a seed round is anywhere between 250 and 2 million, and that's a pretty big range. Mike, I think I've even seen like a seed round around like 5 million. That's kind of new to me that 5 million would be considered seed, but especially on the coast, you're seeing that more and more. The valuations are higher, anywhere between that 750 to $8 million in valuation. At this stage, you likely would still have friends and family, but you're moving more into the angels, the micro VCs, the wealthy individuals to pull together that amount. I would encourage you not to give up more than 20% of your company at this stage. If someone's coming and saying, I want to invest, I want 40% ownership, I would really, really strongly push back, especially if you're on a road to raise multiple rounds. It's just not a good way to start giving up that much of your company. I could go back and forth sometimes. If there's a really large investor, they may start to encourage you to take form a board at this stage, but typically you don't even have a board yet because of the legal and financial overhead that a board would even bring at this point in the company. As far as revenue goes, you might be between 0 and 50,000 of monthly recurring revenue. The preference is probably a 1X team. You're probably at the stage where you have some market fit, you have some, sales DNA. You might not have a VP of sales yet or any, big structure around that, but there's some traction around sales. There's product design, and you show that you have some sort of strong tech. As far as tech goes, you've proven that you have the ability to build things. I think that's a really important part at this stage. It's not just an idea. You've proven you can take a concept and actually build it and show them something. Sales and marketing, strong indication of demand, et cetera. Then moving on to Series A, this is usually where you're seeing more of like a $3 million to $10 million raise. Your valuations are much higher. You're probably going after venture capitalists at that point to be your investors. Again, the ownership would probably only still be around that 20%. They're likely to want a board seat. Revenue expectations are going to be much higher, 100 to 250K. And this isn't set in stone. I've seen a company recently raise a couple million with really no revenue. So again, like this isn't hard and fast rules, but generally, what kind of bucket are they going to be looking to put you in at this stage? Team, they're probably not expecting an all-star set of VPs yet, but probably with the funds that you raise in this round, they're starting to want you to build out your team. And again, it's okay to have some holes at this point. So I'm not going to go line item by line item, but hopefully this kind of gives you a, where am I at? What am I expected to kind of fit as far as an investor's buckets? And maybe where am I weak? If you feel like you're weak in a couple of these areas, I might say like double down on trying to get some sales traction before you really go out and get that raise. Double down on really getting your technology in a working state before you go for the raise, et cetera. So just thinking through kind of those milestones. And then once you raise that seed round, what are the milestones expected to get you to that Series A? Can you get there with these funds? Because there's a progression along, each of these columns. I'm going to pause. There's a question here. Is this chart assuming the company is a tech company with large MRR potential? If so, what about non-tech, lower margin and revenue potential? Good question, Patrick. I would say this whole seminar, when Mike and I put it together, it's really assuming this is the audience is tech-based companies. Non-tech-based companies really, I would say, like live in a different realm. The things that we're talking about, I think there's parallels and you can pull useful information from here. But know that this whole series is really for those kind of tech-based high growth companies. Mike, anything to add on that question?
I think the only thing I'd add is you can sometimes see these kinds of large amounts raised for a non-tech company, but it usually comes from someone who's very strategic. So if you're in a tech and development, or in a development space where you're adding something to a market that's already there, but it's not technology, it still can have a ton of leverage for other players in the market. So it probably just changes who the investor would be, first and foremost, and what influence you have in the market. And that would be the way you might get into these more large scale investors. Otherwise, you're going to be looking at more friends and family, banking, lending, those kinds of.
One other kind of general observation, and I'll share this like personal entrepreneur annoyance, was sometimes the pressure on revenue, right? I think 10 years ago, there were companies that were raising a lot of money with no revenue. That may still be happening in niche circles, but I think that's changed quite a bit. The revenue expectation is there. And as an entrepreneur, the frustration is like, well, if I had all this revenue, I wouldn't need your money, right? I think we can all feel that pain of, if I was making money, I wouldn't need investor money. And so thinking about how you get really creative about creating revenue, right? What can you bootstrap do to get some revenue in there? And also, if you take a step back, why does an investor care about revenue? And to me, I think they see revenue as a validation of your product working, of people saying, I'm going to buy this. And so I think that it creates this like interesting dynamic from the entrepreneur standpoint and the investor standpoint of like, how do I get revenue? And how do I go about creatively getting it without, having all those dollars around marketing, around hiring the best sales team, around having the perfect product. And there's really a tension that exists, I think, in that area, especially when you think about, well, I want my revenue to be scalable. Sometimes early revenue is just testing out what people are willing to pay for. And in my perspective, I step back from all of this, the kind of entrepreneur annoyance of like, why do they want so much revenue? I need money to get it. Really, being an entrepreneur is like solving tough problems. Getting that early revenue is one of the toughest problems you're going to have to solve, and especially if you don't have a lot of money to solve it. So don't kind of lose sight around that. I think there's times as an entrepreneur, you have a vision of where you want your product to be before you start selling it. And sometimes like the perfect reality and vision isn't the way that like you have to, it's messier. It's messier. You have to start selling your product earlier before it's perfect. And you have to overcome some of those fears. My fear was like, well, if we launch what I saw as a crappy product, are we going to have a bad brand reputation? Well, you can manage those things. And getting people to pay for your product is the best validation. And frankly, it's going to make your product better. So don't get in your head about the perfect product without any sales. Because an investor's just, they expect it. Don't get in your head about, I can't sell my product until I have the perfect sales team. I'm not a salesperson. Too bad. You got to figure out how to sell it. Mike, anything to add on that? You're kind of chuckling or shaking your head.
I am. One thing I've seen that was really effective in this is the baseball analogy holds. Don't try to go hit home runs, hit singles. Sometimes what you do is sell a very, very, very small part of your product for a very small amount of money to the target audience. And while that is not, oh my God, I've got all this revenue, maybe it is, hey, I've got 21 chief compliance officers paying me $99 a year for this little informal, I don't know, widget or whatever that's keeping them informed about one thing in their place that's really worth a lot to them. And what you're communicating is not that I can go get about money with that widget, but I just built relationships with 21 buyers that can pay up to $500,000 a year for the product I plan to build. And I built a relationship, which by the way, is the hardest part of sales. it is getting a relationship built where there's some trust and some willing to interact.
All right. What makes a company fundable? There was a great article that we put in here, embedded in here, and will be in the appendix. When I think about what is an investor looking for, there's several buckets. I think they're looking for check, check, check. So big market opportunity. These investors want they want a big return. So they're not looking for someone who can get to 10 to $20 million in revenue. They're looking for a company and an idea that is much, much more than that. They're looking for those really billion-dollar opportunities. They realize that that might take many years to get there, but that there's a potential there. What is your team like? What's your team vision, background, commitment? Sometimes, teams maybe lack the experience, but they bring the vision and commitment that really gets an investor excited. Strong business model. Does the model make sense? Does it scale? What's the profit margin? Does it make sense? And then Mike really talked about this earlier, but what's your secret sauce? What's your competitive moat? What gives you guys an advantage that someone else with $100 million would have a hard time competing against you? And that one's tough. Sometimes you're like, I'm kind of creating, what is my competitive moat? What is my secret sauce? But really be thoughtful about what that is. What's going to set you apart, maybe with someone else who's trying to do the same thing. Linda, this might start to get on your first question, but what am I raising? A seed, an angel, an A? What is it? How much should I raise? I love this quote by Mark Suster. He really says, none of it will matter unless you build shit people care about and use. I'm not going to read all of it, but it goes back to momentum, right? You have to really have some momentum and something that customers care about. And the only point I will make here is early on in Dwolla, we called our first round a Series A, and it was, just around $1 million. Looking back, that should have been a seed round. It should have been called a seed round. And what that did over time was, this wasn't a huge deal, but it was just one more thing to explain in the fundraising. When we went to raise our Series B, which was around 5 million, a lot of people we were actually at that stage of a Series A. So if you're looking through the checkbox of where are they at product market fit, where are they at revenue, where are they at team, we fit the A, but we were calling it a Series B, right? So then fast forward to we were raising a C and we were really in that B category. So this is where naming early on, like, again, don't sweat the silly optics as a seed one, a seed two, an angel, whatever. But when you start calling things A, B, C, it's expected you're like at these milestones. So that's where the naming does somewhat matter. And don't be in a rush to call it an A, is I think the overarching lesson that I learned.
Yeah, and one thing to keep in mind is the world of fundraising massively changed in the last 12 months, in the sense that if you were in the Midwest, in Iowa, or you're in Michigan, or you're in, Utah, the fundraising world was not as crazy as it is in the Valley or New York, where somebody might have a $5 or $10 million seed round, right? So there was kind of an accepted difference in terminology, different expectations. Well, now most good investors are taking calls from across the country and the world, and it's all becoming flattened out. So this is an even more important thing to say. Look, I'm keep my terminology to seed round, because while I think a seed round is $1 million or $2 million max, we've got people on the coast now looking at deal flow in Iowa and Illinois and Wisconsin and everywhere else in the country, going, well, and I'm seeing seed rounds as 5 and 10 million. So the terminology difference based on region is going to have to go away. So you don't have to name your round. You don't have to say I'm raising a seed round. You can say I'm raising a small round.
Thanks, Mike. There's another question here from Patrick. What percentage of startups do you think actually have a realistic $1 billion market opportunity? What percentage of entrepreneurs actually can access these investors? Well, I think Mike started to ask this, answer the second part. access to investors has really, the playing field, in my opinion, has been leveled quite a bit by more things being digital, virtual, et cetera, which is a good thing for, I think, all entrepreneurs. In my case personally, I didn't have to move to California, but in some sense, I had to move to California to get those funds 7, 8 years ago. And they wanted you close. They wanted you close to all their resources, et cetera. So access is really kind of interesting. If you think about the fundraising that had been done in the Midwest, you kind of tapped out at a certain point with Midwest investors. Luckily, as Mike mentioned, I think that really has changed quite a bit over the last year, especially. And then, to ask to go back to your first question, what ideas really are, $1 billion market opportunity. I think that, having $1 billion idea is, I'll call it $1 billion idea, is exceptional. And you're lucky if you kind of tap into that. Not every startup is going to have that. And I think it plays into your kind of second question, Patrick, is if you don't have really the pathway to a massive company, who you raise from, what kind of trajectory you have will be different. There's just, no other way around it. The amount of capital you raise should be different. When you look for acquisition should be different. I would say, in my opinion, Midwest investors sometimes are less focused on these, massive 10x billion-dollar opportunities and more focused on, hey, if you can get to 10 to 20 million in revenue, there's going to be an opportunity for a sale and we're all going to make money on it. Does that answer your question, Patrick?
Yeah, a bit. I mean, I signed up for this seminar. I didn't realize it was just for tech companies. I was just rereading through the description. I didn't see that when I signed up. But I think, the challenge I've been seeing and, doing this for 20 some years is that all the conversation is around the companies that are going to be the next $1 billion thing. And especially in the Midwest here, the reality is the vast majority of companies and the companies I fund, they're not the next $1 billion thing. They're going to be really happy with 10 or 20 or $50 million, and they need professional investors as much as anyone else. And so, I just want to have more dialogue around that, because the reality is that traditional venture capitals like Andreessen Horowitz funds well less than 1% of all companies. And so what does the other 99% do that are on the main street in Iowa, in Nebraska, in Minnesota?
So Patrick, maybe I can take that. So I am one of those investors. And I have funded companies that I think will cap out at $7, $8, $9 million in revenue. I have no problem with that because I didn't put a huge amount of money in. The companies don't need a huge amount of money to grow. They're a totally different kind of company. And so I think that limiting yourself to the big VCs is a mistake. Later in the presentation, we're going to give you a link to all of the seed funds in the Midwest area. And there's a lot of those seed funds that are not looking for the $1 billion company. They're looking for a level or two smaller. Now, frankly, if you're going to get to 800K in revenue over 10 years, no, you're not. This is the wrong kind of capital. But if you're talking about something that's going to get to $5, $10, $15 million a year in revenue, and by the way, if it's $5 million in SaaS revenue, right now that could be a $40, $50 million valuation company, depending on what market they serve. And the reason they're very attractive is not because they're going to go public. It's because they're going to get acquired or rolled up into a larger suite of products or into someone else's product. And you see this on a regular basis. If you're out on Crunchbase or whatever, companies get acquired for 10, 20, 30, 40, 50 million, not because they're trying to stand them alone, because they're going to combine them with something else.
Yeah, and maybe that's, Mike, thank you. And Patrick, I appreciate the questions. I think it's always matching up where you are and like, who's your target audience, right? So what kind of startup are you? What kind of revenue potential do you have? And then what kind of investors can you go after? We will be hitting on that a little later on. So the dialogue is helpful. And I also think, if we go back to that market opportunity, big market opportunity. It might not be your revenue potential market opportunity, but like Mike said, are you playing in a market that's big enough that there's funds there to, an interest there to acquire you? Is there a path to an exit? And I'm not talking IPO, I'm talking acquisition. And it has to at least be a big enough market opportunity that someone's gonna buy you because it rolls into something else. Dennis, I'm gonna move to your question. If a company is looking for next 6 months and need to raise a smaller round, maybe less than 500K, what's the investor's rationale regarding if that period makes sense? Is there general principle in terms of time between these initial small rounds? This is a great segue into the next couple slides. I'm going to continue to move with the slides, and I hope that we answer your question. If we get 3 or 4 slides down and it's not, let's come back to it. So the question about how much money to raise when you're thinking about your tech startup, there's multiple ways to go about this. So I would say option A, I call this kind of the ideal, sometimes the ideal world, where you would go through your pro forma and figure out, what are my product development needs? Do I have inventory needs? What are all my expenses? What's my burn rate? How long do I think it's going to take to scale up my selling, et cetera? So you kind of come up with that. And, when you add on the burn rate, the sales cycle, you come to a certain point. In this scenario, it was 2.7 million. Another option is raise enough money to achieve a certain amount of milestones that you think attract the next set of money. Although, raising 15 to 18 month runway is absolutely ideal. When in these early stages, I often find it's sometimes isn't a reality. I'm going to use the Global Insurance Accelerator as an example, as the companies that I've seen the last 5 years go through. And maybe Nicole, Megan, you can add into this. I would say only one of those companies has been able to raise in this kind of option A, where they say, these are all my costs. This is how long it's going to get me to profitability, my sales cycle. I'm going to raise 2.5 million. I think one company in the last 5 years, so that's 50 cohorts, has been able to raise down that path. And I think because they were a multiple time entrepreneur, their idea was great in this kind of hot space. And they had access to, their friends essentially were venture capitalists. So they were able to raise that path. For all of the other of us, the 49 other, the 99% other, I think option B is probably more realistic. And it's not to say that you shouldn't go through the exercise of A and knowing really what that financial model looks like, looking at how long would it take me to get to a really solid point from a sales perspective. But what I'm seeing personally in the entrepreneurs that I've been working with is you need to kind of chunk that out. And Dennis, this is where hey, what can I get to in the next 6 months? Is it, I need to have my product done and in pilot with 2 or 3 customers. And that is a significant milestone, right? Where you want to be careful is not raising enough to really get anywhere, right? You raise 200K and if you say, here's my traction, there's really nothing in there to get an investor excited. And this can be really challenging early on, right? This is where bootstrapping really comes in. You get really creative around the hustle, and the creativity to show momentum comes in. Dennis, does that answer your question?
Yes, thank you.
Yeah, you're welcome. And I would say sometimes raising that smaller amount, 200 to 500K, allows you to put that money to work rather than spending 9 months trying to raise $2 million, right? What do you give up? You give up time in that. So the more you can focus on getting the fundraise done and back to work, back to building what your business is all about, I think will always benefit you. There's another entrepreneur that I saw who just did an incredible job managing milestone communication with his investors and potential investors. He was very clear of, this is what I'm raising, this is where I'm going to get. And he had to hedge that, right? He had to like make sure he wasn't like over promising. And at a time, his milestones were kind of like, like to me, I'm an investor in his company and I'm like, oh, come on, you can be a little more aggressive. But he was very realistic. And then like, this is what I'm going to do with this money. This is where I'm going to get. And every single month he would communicate where he was at. And he said, this is where I'm going. This is where I'm going to get before I raise my next round. And he managed that so well that like everyone's like, yep, he said he did what he said he was going to do. And a lot of us reinvested in him because we're like, okay, he's very clear about where he's trying to get. So, as an entrepreneur, I would just, encourage you, if you can, to have some clarity and communicate that with investors, and they're going to appreciate that you do what you say you're going to do. You're executing down a path and being good stewards of those funds. So when you think about a software company, again, this is very software company based. What is your company worth? And as an entrepreneur, I was very frustrated about this. I would love for there to be a more mathematical science to it. What I often found was my valuation was determined by how much the investor expected to own. And so, typically they want to own 20 to 25%, at that little bit, not that first amount of money you bring in, but that angel round, they're looking at 20 to 25%. So automatically that creates a valuation for you. And really early on, I think it's hard to justify that the reality is your company really worth $4 or $5 million at this stage? I don't think anyone will really buy it for you from you at that, but that's really how I think the valuations are set. As you get further along in your startup, as a SaaS-based company, they will start to look at multiple of revenues and how does your recurring revenue stack up and what's the future market opportunity. And they're whole companies that will do valuation analysis for you a little bit later on, but early on, it really is, hey, I want 20 to 25% of your company. Therefore, you're worth $4 to $5 million if you're raising $1 million. Linda, does that also help? I think that was a question you sort of had early on. Hopefully this is all coming together. Okay. Seed and angel valuations. As Mike was saying, what I found is based on geography, the valuations can span quite a big range. Like in the Silicon Valley, those early seed valuations are $4 to $5 million, sometimes even higher recently. Europe tends to be a little bit lower. I would say Iowa in the Midwest. Typically you're going to raise less than $500K on a $2 million valuation. I think the important thing to note is the percentage still stays intact. So it's not that your company it's going to be a lower valuation in the Midwest, but the amount you're raising is also lower. So instead of raising maybe like $2 million right off the bat, it's going to be kind of that $500K at a $2 million valuation, but it still fits in that, 20% ownership. I am really excited for the entrepreneur community, regardless of where you're at, to see some of this leveling out. We're seeing like geographies just disappear. And that, I think it's going to be a more level playing field because investors from all over the world are now truly investing all over the world, where they used to they would say they're investing everywhere, but they really were investing kind of in their geographies. Mike?
I think one of the things that's going to happen too is I think you're going to see the slide in 3 years won't say Silicon Valley, New York, blah, blah, blah. It will say large scale consumer startup versus large scale vertical market startup versus mid-market startup. Because where some of these crazy Silicon Valley valuations come from is you take somebody like Calm. which nobody even heard of 5 years ago. They did an angel round around an $8 million valuation, right? Which doesn't sound crazy. I mean, they took down, I think, $1 million or $2 million at 8. They already had traction. They had a product that worked. But, their last raise was at a $3 billion valuation because these guys got huge and make a lot of money. A lot of the companies, the people on these calls are all of you in this audience don't have an opportunity to go do 3 billion, someday of revenue. They just don't. They're vertical market apps, they're niche market apps. And so I really believe you're going to see this whole thing change, that the valuation differences will be based on what the opportunity is, which frankly is what a lot of Silicon Valley was swinging for. They were looking for, I want to know if you can get to $1 billion. And it wasn't just $1 billion. I want to know if you're in a big enough market. So I really think it becomes market oriented.
Thanks, Mike. All right. I suggest we take a break. Probably everyone needs to get up, stretch, use the bathroom, fill up a cup of coffee. It is 9:40 right now. Mike, what do you think? 15 minutes?
Yeah, let's take 15. That'd be great. So feel free to just, leave yourself connected. You don't need to disconnect. If you want to kill your camera, that's fine. We'll be back at 55 after the hour.
All right. Should we, looks like a fair amount of people are back on. So I'm going to just kick this off and keep moving. Again, thanks for being interactive. Thanks for the questions. Thanks for keeping your video on and showing me that, this is yes, no is resonating. We're still all together. We're going to move next into, managing the fundraising process. We've talked about the momentum needed, the materials, the different kind of investor approaches, valuations. Now we're going to get a little bit more into what does it look like as a sales process? And I know you're going to be looking at this and be like, this seems really straightforward. But it was a part of what I don't think I was conscious of going through the fundraising process. I was never aware of I'm managing this like a sales process. I just hadn't thought about it like that. And as I stepped away from it, I'm like, it's absolutely a sales process. And so some of you that have sales DNA, you're going to be like, okay, I'm going to run this like a sales process. For some of you, you've never done sales, never formally done sales. So this is not sales 101, but more just how I put a sales lens on fundraising. So if you start at the top, you want to fill the sales funnel, right? So how do you do that? Normally think about the marketing, where marketing and sales collide. Absolutely think about how are you building awareness about what your startup is. It's a really important part of not getting to this really hard part of just cold calling people and sending them your pitch deck and no one responding to you. So think about how are you building awareness, and that can be done in multiple ways. Then how do you nurture those relationships? How are you qualifying them? How are you getting to know them? How are they getting to know you? We're going to talk about some specific questions to ask. Then there's an evaluation, mutual evaluation. I would say this process is both for you and the investor that you go through, and then you close the deal. So hopefully, as you think about that, closing is way at the bottom. A lot of people just want to jump to closing, but there's a whole funnel that really kind of trickles down into getting to that close. So let's think first about that top of the funnel. What are the different investor strategies? Who are your potential investors? I'm going to go through, I think, 5 different areas of investor strategies. So really determining who is your customer, who is your investor. So friends and family around, this is often ways that entrepreneurs will start. In this type of strategy, you would set the terms. Your friends aren't going to say, here are the terms. You as the entrepreneur will set those terms. Multiple friends and family would invest, and likely they wouldn't have a board seat. A lot of investors later on want to look for validation that people that know you have put money in the company. It's showing that they know you, they trust you, they believe in you, and therefore they've been willing to write a check. Mike, were you going to add something in? Oh, okay. Your mute had come off. So another kind of strategy early on would be that angel seed round. So when I think about angel, these are often, multiple angel individuals or wealthy individuals that you probably don't know personally. Again, in this strategy, you would lead the terms. You would set how much you're raising, at what valuation. Is it debt? Is it equity? What is it? Again, likely they wouldn't have a board seat. Another approach would be an angel seed round where you actually have a lead investor. And this is where an angel or a micro VC is saying, I want 20%, I'll do the diligence, I have expertise that is relevant to your company. And, when you have an investor lead around, this is normally where they would require a board seat, be a little more hands-on. Sometimes people get stuck between what I call 2 and 3. So I'm going to back up a second. 2, again, is where the company sets the terms and brings multiple angels in. And 3 is where an angel set the terms and you have a lead. And why I say people get stuck there is as an entrepreneur, it's in your benefit to have the investor lead the round, right? Like if they're setting the terms, they might set them way higher than what you would set. And so it creates a market dynamic of like almost like a bidding for your company. I want to be the lead. These are my terms. So as an entrepreneur, you're gunning for number 3. The reality is sometimes you can't find that lead to set those terms. So as the company, you have to set them. And Mike, I would love your perspective on this. This is where I see entrepreneurs waste a ton of time. They're gunning for number 3, but then they have to eventually fall back on 2. And I always push people to say, do you already know leads? In considering the path you go down, do you already know some people that could lead? If not, you may just start with the route 2, which is I'm going to set my terms, shop a bunch of people and bring them all together. Mike, thoughts on this?
Yeah, I think it's a valid point. On early stage, I think you can get there faster if you do it that way. If you can pull it together. I mean, there's always that big if. And I think one of the best ways to do that is with a note. I mean, you see a lot of convertible notes out there. I'm not a big fan of safe notes as an investor. They're a little too wide open for me, but safe notes with good side letters or convertible notes are a very simple way to do it and not have to set a valuation, not have to deal with all the terms. And so this is the point where I always ask the entrepreneur, and I'm tongue in cheek, are you here to raise money or are you here to build a company? Get the money, get back to work. And maybe you have to give up a few things on terms, maybe you don't. The nice thing about notes, if some seed group wants to come in and they come in late and you've already taken down 300 or 400K in notes, it doesn't force them to say, I can't be in for those terms. They can come in on the note round and not be, out of covenants with their investors, if you will, or out of bounds with their own investors. So again, notes are something you want to be careful with long term, but early stage notes have a lot of value. You just have to think through all the pieces and parts of how they convert. And we'll be covering that in term sheet and cap table, probably more in depth.
Thanks, Mike. So as an entrepreneur, just thinking, really understanding what the difference is in this, number 2 strategy versus number 3 strategy. Again, it's where I see people get kind of hung up, and in not picking a path can lead to a deal not getting done. Another investor strategy is strategic investors. And, there's some trade-offs to strategic investors. They can help in a lot of ways. They might open a commercial deal. They might sign a contract with you themselves. Sometimes they're a strategic often is a brand, a name that people recognize. So they can create some legitimacy. They often bring a lot of domain experience too. So they can be really helpful on that front. They can hurt in they're often investing as strategic because they have some pretty strong self-interest. So they might get kind of selfish in the way that they guide your company. They might have too much influence on the direction of your company, especially if they're a customer. They can really kind of push your product in a way that maybe is really good for them and maybe is leaving out a big part of the market. So are you building for everyone or are you building for them as the strategic? They might block other competitors from doing business with you. And, this would say like a not good strategic might block future investment rounds. I would say like a good strategic partner is a partner and they should help future investment rounds. But I've seen strategics do things that are really selfish and not good for the company and block future rounds. So once you think about, what's kind of my strategy, what type of people do I want to fill my funnel with? This is then further refining who is the ideal investor, what's the profile of them. And these are some, these bullet points are different areas for you to think about your investors. Is there a specific stage that they invest in? Is there a sector that they like to invest in? Do they only do insurtech, ag tech, consumer tech? What is it? Do they do everything? What kind of customer types do they like? Do they like SaaS businesses? Do they like enterprise sales? Do they like the B2B? Do they like consumer businesses? Do they have a sweet spot? Do they require a certain revenue amount? Demographically, do they have preferences? Have they invested in any of your competitors? And this isn't to say that if they invest in a competitor, they won't invest with you. But as an entrepreneur, you really have to be thoughtful of like, do you want an investor who's invested in your competition also being an investor in you? Do they have a category that they care about? A lot of this information you can find on Crunchbase. Others of it you have to really start to discern by when you have calls with them, asking them these starts of questions. So as you fill your funnel, you're actually filling them with the wrong people, or the right people. I'm sorry. I was thinking ahead. An entrepreneur I've worked with, he had a lot of national buzz. And so a lot of investors would call him, show interest in him. And his whole investor profile, like he had this whole spreadsheet of all these investors he talked to. And I looked at him and I said, you're trying to raise like $1 million. None of these investors have ever written a check that small. Like these are the wrong investors to have on your sheet. And he was kind of like, what? They said, well, they're interested in me. They're calling me. They're setting up meetings. And I was like, yeah, they want to get to know you for 3 years down the ground. This is not the investors that you're going to be going after to get this round done. And I think he was a little disheartened. Like he'd done all the right work. He was doing all these calls. He was keeping it organized, but they were the wrong profile. Like they were in the wrong stage for where he was at. And I'm not to say like he was doing the right thing in managing those relationships, but he was really naive to think that they were going to invest at this round. Like there was a whole subset of investors that he needed to get to know for the current now. So something I would say,
asking those questions.
Go ahead.
There's nothing wrong with just asking that question, right? I mean, I think it's one of the mistakes entrepreneurs make is they don't ask the direct questions because you do want to keep them in mind for a future round, but you need to know how much time to spend on them. So to that point, just ask, are you the type of investor that takes a part of a round that is only $1 million?
And it can be, deceiving is the wrong word, but as an entrepreneur, you can be very excited about these investors talking with you and having excitement about what you do. But it sometimes can give you a false sense of false sense of confidence that you're going to get this future round done. Because they just aren't in the capacity to invest now, but they don't want to miss out the next round that they are a good fit. That's why they're investing all this time in you at this point. So, okay. Keeping your investors organized. I know that there's really fancy software out there. You might already use sales software. If so, go ahead and use a sales software, but I would say there's nothing wrong with a simple spreadsheet to keep you organized. Some of the things to think about is, who's the firm, who's the contact, how big is their fund size? This kind of gives you some indication of what kind of check size they would write. What is their check size? Again, you're going to probably have to ask these questions. Some of it you can find on Crunchbase and other sources. Others you have to simply ask, do they lead? Yes or no? Do they require a lead? Have they, invested in any companies like mine? And then the word on the street, are you able to talk to other entrepreneurs? What are they saying about that investor? Do they have a good reputation? Do they not? et cetera. And then the really the last column that should be in here that isn't is, when was the last state of contact, and is there a next step with them? You'd be amazed at how often you kind of can forget about people. And it can come back to bite you. You have a great conversation with someone, they like you, you like them, you get all in the hustle and bustle, and like 6 months later you close a round without them, and you run into them at a tech conference and they're like, hey, I'm really excited about your round, and you're like, it's already closed, right? And then they're a little put off, like, you didn't even give me an opportunity to invest. Or you said you were going to send them, hey, I'm working on this new product launch. When I get it done, I'm going to send you a follow-up, or I'm going to, get it to you. And then you never send it to them. I mean, you dropped the ball. So you have to think about, as you're having, the first 5 conversations you think you can mentally keep track of, the next five, all of a sudden you're talking to 20-some investors and you don't honestly remember what you said to which ones. So for those of you that aren't organized, think about how you're going to get organized. Think about what tools you use to get organized, so you don't kind of drop the ball on some of this. There's a lot of tools out there to utilize to research and find investors. Crunchbase, PitchBook, some public list. These are simply like things that I Googled. Midwest tech investors, hardware investors, VC funds below 200 million. I mean, you could try and list online of investors. Within this deck, we put together a fair amount of list of investors too that are more Midwest based. There's several regional syndicates, and the nice thing about these syndicates, like for example, Mike, I'll use Plain Angels. If you decide Plain Angels to invest in something, you have relationships with the other groups out of Omaha, out of Minneapolis, out of Kansas City, and you say, hey, Nebraska Angels, we're investing in this. Are you interested as well? So there's some networking effect that can go into these groups. There's quite a few angel groups in the surrounding areas. So again, we really focused on the Midwest. For a lot of you, having ties with either the GIA or being a Midwest company, I think you can find these really helpful. Again, I'm not going to go through them, but there's pages and pages here to just show, the amount of groups that exist here in the Midwest. If you are in one of the coasts, you're going to find there's a whole set of micro VCs and angels geographically where you're at. Again, as we've mentioned earlier, those geography boundaries are starting to break down in the time of the world being more virtual. But there's something about, having with a relationship. So that what is the connection in with these VCs or angels? What are the relationships that exist that can get you connected?
I can add one thing there, Cherise.
Go ahead, Mike.
Yeah. So one of the things to know about, so there was quite a list, and I dropped the link into the chat for that Midwest list. A lot of those people that are in Chicago invest nationally or beyond. So don't think, they're Midwest, so they only invest in the Midwest. That's not at all true. And one nice thing to know about them is very few of them want to take your whole round. Most of them want to have others in the round with them. They want to spread their risk. So if you're raising $1 million and they might be interested in leading with you for $300K, $400K, they're going to be able to help you find other funds. And they oftentimes partner with other funds and share deals back and forth. So these people can be an amazing asset and influence. If nothing else, you may have the phone call that says, hey, you're not a fit for our fund, but we know 3 funds that like stuff like this. And let me make a connection for you. So I think that just know that they're not, because they're in the Midwest doesn't mean they only invest in the Midwest.
Thanks, Mike. So just kind of closing the loop on filling the top of the funnel, building awareness. And if you have the ability to get PR, it can be extremely helpful. Pitch competitions. I'm not always a huge fan of the companies that spend weeks and months going to pitch competitions, but they do have a benefit in the sense of who's in the audience, right? Those pitch competitions get investors that tune into them. So be careful about where you're spending your time. Sometimes you're doing it purely to build awareness and to get connected to investors. Same with conferences. I've seen CEOs become like conference junkies, where all they're doing is going to conferences, and it can create a lot of noise. But in the same sense, it can create those connections. You know, it gives you the opportunity to be in front of people you normally wouldn't be in front of. I think the time of COVID is really interesting because it doesn't take you 2 days to go to a conference. You literally could jump on a Zoom conference, get the same benefits, and get off. So I think there's some accelerated benefits that are happening right now. CEO introductions. Think about your network of other entrepreneurs who have they had as investors in their company. Would they make introductions to you? Be mindful, though, of how you're asking for introductions. I used to get people to reach out to me all the time saying, hey, Ashton Kutcher was an investor. Can you make me an introduction? And I was like, I don't even know who you are. I don't know anything about your company. Why would I just make an introduction to you? So I don't be naive. Don't be kind of that person who like blatantly asks for an introduction without the CEO knowing anything about you. I mean, these should be relationships, people that know you, people that would be willing to open their kind of Rolodex for you. But as entrepreneurs, I know we've all been through it. So once we have the opportunity to get to know you, get excited about what you're doing, we're more than willing to open up our networks. Accelerators can be a great way to access investors and build that awareness. And lastly, I mean, all of this is just about building relationships. I pulled it in here as well. Like, don't forget, you need to be demonstrating momentum in all of these, in the awareness that you're building. So focusing on how is your momentum around product, early use, sales, etc. Now, as you kind of think about narrowing the funnel, you definitely have to nurture, but let's just go to qualified. So how are you qualifying? What is their fund size? Do they usually invest in less, seed type of investors usually have a fund that's less than 100 million, just as a benchmark. It's not always the case, but it's a good benchmark. What size of check do they write? Again, are you qualifying them? Do they lead? Do they not lead? Do they require a lead? Or would they be willing for you to set the terms and pull the group together? Who's the ideal person to talk to? Some of these funds, they have analysts that will reach out and have the first meetings with you. The analyst is not the person you have to ultimately convince to get the deal done. So if you're talking to an analyst, know that it's the first stage, but you should be hoping that you get an introduction to one of the partners, because the analyst doesn't have the ability to write the check. And then, as you're thinking about qualification of them, what's their reputation? I'm going to pause a second. There's some questions coming in. What is your thought on the investment platforms like Gus.com, FS6? Mike, I'm going to let you talk to that one. You have the most experience with it.
Sure. The platforms are good to find investors in general. So Gus.com is used primarily by angels and sometimes small seed funds, but not as a place for you to just broadcast your deal. So typically, if you applied to Plains Angels, we're going to ask you for a Gus profile. And basically, Gus is a deal room software. And so basically, it's a place you can securely put your financials, your pitch deck, information about who you are, your summary, and not have to send it out to everybody as an email every time. And once you've done it once, so let's say, hey, Plains is really interested, looks like we're going to invest in you. We have a syndicate call and we tell everybody, hey, by the way, these guys are out there. They'll be reaching out to you and you can just send them your Gus profile. You just send them a link. And it makes it super easy to manage it. And you can also uninvite. So if Gopher says, yeah, we're not interested, uninvite them, take them off. It's a place where you can keep things up to date. So I'm a fan of it as a tool to get your information to the investors. I wouldn't tell you it's a place to go shopping for an investor per se, because there are probably 3,000 or 4,000 out there. Now, if you are selling software for lawyers, Gus wouldn't be a bad place to go, because there are angel groups that do nothing but fund software for lawyers. Okay, I mean, they exist. They're very niche-y. But again, you just have to be aware. Now, F6S, I believe, Megan or Nicole, I don't know if you guys are on here, but I think that's one of the ones that's through the accelerators, through is it, I don't know if it's Techstars or whose it is, but I think it's more of just a connection point. Angel List is a good one to look for investors on. Again, just know that it's a pretty big pool out there, so you have to be smart about your search terms. I'd also throw out Angel List as a great way to find your competitors, because they probably all have profiles out there.
Great question. Another question here. What are some ways you can maintain momentum when a round might take 6 to 9 months? Often a company has unevenly distributed successes. Great question, Joshua. I think there's some intentionality that comes about, and what are you trying to accomplish? What do you communicate you're trying to accomplish? And what things can you control and which things can't you control? A lot of times there's a lot of things you can't control, but there are things you can control, right? You can control in the way that you message, expectations around maybe customer successes. There's ways you can control somewhat like product momentum, right? How often are you shipping? Are you hitting milestones? And I think where entrepreneurs often get in trouble is their hope and dreams for what gets accomplished versus what's kind of real are usually two different things. So don't let your own disappointment get in the way. I recall a conversation I had with an entrepreneur. He's like, I wanted to be 50K in sales this month, and I'm at 20K. And I was like, yeah. And a lot of other companies that are out pitching, 20K is an amazing number. So don't apologize for 20K, right? 20K is revenue. So this is where it's like a little bit, you want to be shooting for the moon. But how do you communicate kind of what's realistic, and how do you not, let your own disappointment maybe come through in that conversation? Because from an outside perspective, that you have an MVP and 10 customers is amazing. And in your mind, you wanted 20, but 10 is pretty good. Right. So I think that managing that is really important. Setting expectations, like how much you share with investors, is really important. You don't let your excitement be like, we're going to onboard, these six companies in the next 2 months. And then like 6 months later, you're still working on onboarding. Right. I think you have to be realistic in what you communicate. Just the other day, I had a conversation with an entrepreneur. He has like 6 really large enterprise deals, all gonna happen soon. But soon is relative, right? Soon could be a year, soon could be 3 months. And he's like, how do I manage that with investors I'm talking to, right? And I'm like, carefully. You don't want to say they're all going to happen because you have no control over an enterprise client. And yet there's an excitement to be shared, right? There's an excitement to share with investors. We have momentum in these relationships. And being just realistic, I think as an entrepreneur telling an investor, I don't, as much as they're really excited about this, I don't control that it might be a 6 to 9 month sales process for them to sign. So we have lots in the hopper, but I'm not promising anything in the next couple of months. It's really expectation setting, I think, as much, and not letting your own lows get in the way of what someone externally would perceive as the highs. Does that help, Joshua?
Can I add one thing, Shreese?
Mm-hmm.
I think one of the things people make the mistake of is not communicating consistently. So, and this is before, during, and after the raise. So let's say you're talking to some seed funds about your potential raise 6 months from now. Put them on a list. Communicate with them monthly. Do a 1-pager, something simple, right? And have asks in there. I can't tell you how many times I get a 1-pager from somebody that says, does anybody know someone at this company? Or does anybody have any experience doing this? One, you're communicating progress because you're consistently updating them. 2, a lot of us do know those people and are happy to make the introduction. I may never invest in your company, and that's fine, but if I can make an intro, that feels good, right? So I just tell you to set up a cadence and always stick to it. Because it will, 1, keep you top of mind, and 2, impress them that you actually have follow-up and don't like just disappear for 6 months.
All right. Just closing the loop on the sales funnel. We've talked about it before, but as you're evaluating investors, they're also evaluating you. It's it's mutual. They're looking team, market, business model, competitive mode, and then any red flags, as they continue to get to know you. Do they see a lack of focus? Do they see inconsistency? Do they see lack of execution? That's, some things that they're looking for when they get to know you. And when you think about evaluation, they're evaluating you, but I would say you need to be evaluating them too. It is not out of the norm for you to ask for, contacts of entrepreneurs that they've invested in. And you call those entrepreneurs and say, hey, what's it like to work with investor ABC? Did you like it? What value do they bring? What's the pros and cons? I think that's perfectly natural. I mean, they're digging into you. You should have the same opportunity to dig into them. I know that it can be tiring at this point in the process, right? You have someone that's interested, they're ready to write a check. There's like an instinct of you of like, do the deal. Don't get tired. do your due diligence too. Make sure that it's someone, especially early on, if they're coming into your company at this point, you're going to know them for at least 5 years, if not way longer, right? Like if it's a good relationship, you're going to know these people the rest of your life. So make sure it's someone that you really want to be in business with. It's a little like, I think I find people get desperate. And then, a year later, they're like, oh man, if I would have just taken a little more time, I would have never taken these people's money. So due diligence, what does it look like to prep for due diligence? Prepare your due diligence, form your team. Who, is it your accountant, your lawyer, someone on your team that can help you really get organized? We call it create the receptacle, fill the receptacle, update your receptacle. It's really too late to wait for an investor to give you due diligence to start pulling this together. The being organized makes a good first impression. And so, we're going to provide a lot of the information that's like typical in here. But attorneys and accountants can really help you be organized with the things that you're going to need. Anymore, everyone's doing an online platform. It's either, put your due diligence in, Dropbox, Box, Google Drive. There's others. There's some specific some specific investor related ones. I find in my experience, Dropbox, Box work really well because pretty much every investor has the ability to access those. USB stick, I pretty much put it on here as like, don't use it. You just can't have any control over it. It's old technology. People were still using for them, but like, don't use any USB stick. Due diligence organization. The idea is to set this up in a way that like really spans with your company the next 5 years. And so this is getting a little in the weeds, like how do you go about organizing this? But organization is key, and to be, in my opinion, being able to move quickly. So on your left-hand side here, there's probably going to be 6 or 7 master folders that you're constantly updating. Corporate, management, employees, metrics, financials, customer market, supplier agreements, PR, customer reviews. So then as you have those 6 master folders, like what goes in those, I started to put the subfolders. And the reason that this is like almost manically like organized is you need to be able to reference people. You can't just say, yeah, that document's in the corporate folder. Well, eventually you're going to have 50 documents in the corporate folder. So how would you say, hey, it's in folder 1.03. You'll find the most recent cap table in there. I mean, that's where organization comes into place. Again, the structure is like born out of the hours of wasted time I probably took trying to find things when an investor would send me a list of 2 pages of like, give me all this stuff. And I couldn't just say, here's my due diligence. They wanted it cross-referenced so that they could quickly find it. So again, it's a little manic, but it's based on the madness I had experienced over the years of raising capital. So also create, if you get to a point where I would always have a master due diligence where like as a company, like it was kind of private, I was always filling it. And then as investor, Acme investor, wanted my stuff, I would make a copy of my master and just share it with them. And then that way over time, they would only have access to that kind of point in time and I could unshare them with that. And it would also help me keep organized. If I had 3 investors doing due diligence and maybe they were asking for slightly different things, I would tailor each Dropbox for those investors. Don't share your due diligence until they have serious interest. And I would even say, like, I would try to not really share this amount of information until I had a term sheet. And the reason, because I think the instinct might be like, look at me, I'm so ready for you. Here's all the stuff. But the problem is, if you do that, stuff invites questions. And how much of your time do you want to be answering what from an entrepreneur sometimes can be silly questions? Like, I would have an analyst diving into my due diligence and I'm like, why do you care about that certain date, that contract, da, da, da. I'm like, this really does not matter to my business, but it's the entrepreneur or the analyst job to kind of dig through those due diligence items and find inconsistencies, to ask questions, to make things all covered. So you want the least amount of people looking through your due diligence, so you don't have to manage all those questions, in my opinion. Some investors will give you their due diligence list. Most professional investors will. And that way you can kind of tailor what you provide. Again, less is more. Just provide what they've asked for. And it's okay to say, I don't have XYZ on your list. They have kind of a form list that I think they give to every company, regardless of your seed or C stage. So don't be ashamed to say, like, I just don't have that yet. An example might be audited financials. You're likely not going to have audited financials at a seed stage company. Just tell them that. Yeah, I think that hits on most of the stuff when it comes to due diligence. We provided a full checklist in here. So if you're looking for a way to get pre-organized, these are very common things that they would ask for. Yeah, I'm not going to kind of go through any of those in deep detail. I think they're pretty self-explanatory. And then just, updating the receptacle, get as much of it in there before you raise. If you sign major contracts throughout the, due diligence standpoint, you got to keep updating that. And then after the raise, once you have this created, the more you can continue to update, the less work it will create every time you go into fundraising. All right. I'm going to pause there. Any questions on due diligence? It's a fun topic.
Hi, this is Josh here. Maybe not directly related to due diligence, but kind of. So what are some tactful or responsible ways to communicate what might be bad or is bad news before, during, and after with your investors?
Yeah, that's a great question. One, I think you have to think about honesty. Honesty is really important. But it's also, at what level do you have to communicate with your investor? Some things that can seem horrible as an entrepreneur, like an investor's like, why are you telling me about that? Right. So there's some discernment. I see some people just like, I call it vomiting at the mouth, where I'm just like, just shut up. Like, they don't, like, you're not being dishonest, but they don't need to know all of these things. Right. So one, use some good discernment as far as what you share. The other thing is, the more honest you are, like, it's sort of a non-issue. You might be like really sweating saying, hey, we lost this customer. They were kind of a big part of what we were projecting, whatever. But it's good to just kind of put it out there, more matter of fact, and try to take some of the emotional stuff as an entrepreneur you might be feeling. You might be projecting it as a much bigger deal than just sharing the facts. Share the facts. You never want it to get to an like closing week and you're sharing things. So if you're anticipating them, letting people know, hey, this might happen. I want to let you know. I don't want there to be any surprises. And investors know there's so many ups and downs in a company. I think just knowing that they if everything was all shiny, that'd probably almost be a red flag. Does that help? I mean, that just open communication is really key in that too.
Yeah, and even it's interesting because it seems like different investors want to know different levels of detail as well. So it's almost like it's a conversation that I would need to have before bad news happens, is like, how much do you really want to know on a day-to-day basis versus, because it seems that investors maybe in the similar area, but all have their own different things. One person might say, oh, I wish you had told me that. And another person might have said, well, I don't care about that. Like,
Yeah. I think just using discernment, right? I think, Bernie, you have a great comment here. If you find out about something you feel like you should have learned directly, I mean, that's a good way to lose trust. Thinking about what your communication cycles are, there's an opportunity where if you're kind of bringing someone on the journey of things, like something won't seem so sudden, right? Like you're bringing them on the journey versus just saying this happened, I think that can be helpful. Mike, I mean, we're going to talk about this a little bit, but I think it's a good time to dig into
No,
it.
I think it's a great time. So a couple things. You're better to communicate too much than not enough. I personally get a lot of updates from startups that I've invested in, and some that are just people I've helped. And, do I read the 17-page status report? No, and I hate them. My favorite update, whether it's a one-time update on an issue or whether it's a monthly update or whatever it is the one that has a one-paragraph summary. And typically with the younger crowd, it's titled TL, semicolon, DR. And it's the summary. I lost a client. He represented 11% of next quarter's revenue. Here's what I'm doing to get them back. And here's how I'm filling the hole or not filling the hole. Or here's how I'm cutting expenses. And then see below to read more. That's an incredibly effective way to do a lot of things in this world, whether it's sending an email to someone you've never met. If I barely knew Cherise, and maybe I was on this call and that was it, I'm not going to send her a 3-page email. I'm going to send her a note that says, Cherise, I would like to accomplish this. If it's something you're interested in, I put additional information below. Please let me know either way, and I appreciate your time. Thank you. So it's that same idea of give them the summary and then give them some detail. And don't forget to ask, hey, does anybody know anybody at this company? I found out that the CFO killed my deal. Does anybody know the CFO of this company or know somebody that knows them? So don't be afraid to ask, because I can tell you, well, I'll save it for the next session, but it's frustrating after the fact.
Mike, I also like how you talked about, you as entrepreneurs, your jobs are to solve problems as well. So putting in there how you're, solving a potential problem in addition to here's what happened, here's how I'm going about it. Does they want to, and asking for help? I think that's kind of the key high points. There's another question about what stage should you disclose cap table. For me personally, I don't hold the cap table like super, super tight. Sometimes there's investors that don't love that, everyone knows that they're investors, but yes, there's often times where it's asked for upfront. There are times where you're talking to investors where they really want to know, like, what are they getting into? Is it a mess? Is it clean? How much ownership of the company has already been given away? What does that look like? So if asked for, I think it's totally fine to provide it. Okay, so let's get to the point where you've managed all the process great up to here. You have someone that you like, that they like you. Now it's time to close. Happy day. Your job is done, right? Not so much. Some things that I've seen go wrong here is you just like leave it up to the attorneys to try to get it to a close, and that's absolutely the wrong approach. You might have the greatest attorney, but their job is not to manage the process. Their job is to like do the documents and get those out. So you need to set expectation, and you have to manage them as much. Attorneys are all busy. I found, like, if I say I need to close next week, everything gets done. If I say I need to close in 30 days, it'll take 30 days, so setting realistic expectations. What is realistic from both parties to kind of get to a date, and, setting that mutual close date allows everyone to kind of be working towards a similar spot. If you don't set a close date, inevitably it's going to take way longer. So trying to say, hey, is it realistic on both sides that we close in the next 15 days? And as an example, be sure of like, what are everyone's roles, who's doing what, who's doing first drafts, who needs to revise drafts, etc. And you can ask your attorney to help you come up with a checklist. Like the first couple of times, I didn't know what documents were needing. So how am I supposed to manage something I don't even know the moving pieces of? So ask your attorney. I know some attorneys that do a lot of deals will actually put together a checklist for you. And then, it's your job to keep a pulse on this. Knowing who needs to sign what. We were managing like a $10 million deal. And I thought all my investors would be ready to sign, right? We've been communicating about it. They knew about it. Like little did I know that one of my investors was going to be like literally off the grid, like not digital access for 5 days. I mean, so we got all the way to like signing documents and his office is like, he can't sign. He's like in Peru or something. So it sounds silly, like know when people need to sign, who needs to sign, how you're going to get those signatures. There's great software anymore that all of it can be done digitally. Back in the day, some of my things, we were like FedExing packages to hotel rooms and my investors were flying all over the world. I mean, it was a nightmare, but it's a lot easier now, but you do need digital access and to set those expectations. Don't forget, there's certain things that your attorneys can help with, but like there's W-9 forms for LLCs. There's lots of documents that require lots of signatures. So just managing, how much of that are you in charge of? How much is your attorney going to do, et cetera. And at the end of the close, update your document receptacle. It's the best time. You have everything, put them in your Dropbox so that next time you're not like, hey, where are all my closing documents for this? Where are all the board charters, et cetera. And then, update the cap table and make sure that the share certificates are issued. Again, that's something that often the attorneys will help you with. And there's been a lot of advances in software that's available to do these things. Something that we talk about normally earlier is like the importance of an attorney. I've seen, as entrepreneurs, we want to save money, right? We have to be scrappy. There's not always a ton of money. Please don't skimp on not using an attorney for a close. There's just so many things that can go wrong, and it will cause a lot of complications down the road. So yes, like a closing might cost $5,000 to $10,000. I know that's a big amount. There's a reason why I think you should invest that amount of money. And it depends on the structure, right? If you do debt or equity, it will cost more or less. But there's a lot of mistakes as an entrepreneur you can make by grabbing documents off the internet and trying to manage your own cap table, et cetera. Mike, anything to add on that? I mean, you've seen some deals that get really messy. I mean, and even just like regulations. I mean, there's regulations around disclosures and filings that have to be made.
I'll tell you where my perspective is as an investor mostly, but if you don't have an attorney with experience at this, I don't want to do a deal with you, period. And I won't. If I hear the word LegalZoom, I'm going to walk away. It's kind of like doctors. There are some amazing doctors out there, but the difference between a podiatrist and a heart surgeon is dramatic. And so you could have a great lawyer as your sister-in-law, brother-in-law, whatever, your dad. It doesn't mean they know what the heck they're doing with these kinds of documents. And we're going to cover this more in later seminar sessions, but there are standard forms out there that save a tremendous amount of time from the National Venture Capital Association that you just use the standard form. And the lawyer's there to help you tailor it to your deal, not to write the darn thing. So what you don't want is a custom written document, because the minute they find out you're not an NCVA standard form, it's like, oh my God, we have to have a lawyer read this thing with a magnifying glass. We're not going there. Let's just walk away. So it can kill a deal.
Yeah, and later on in deals, one of our venture capitalists basically said, unless you use this lawyer who all investors are used to working with, we're not going to work with you, right? It was just like, this was the standard. They do a ton of deals. They're on like both sides of the table. Everyone knows them. They know that like the deal is not going to get messed up. It's just not something that investors don't want to mess around with. Okay. After the raise, Mike, I think I'm going to turn this part over to you.
Sure. Yep. Go ahead. Next slide. Okay, so you've raised some money. Don't be a stranger. We want to be part of the team. As an investor, we want to know what's going on. We want to be part of the team. I really like monthly updates. I like them 1 to 2 pages long. I have a pet peeve about 7-point fonts. Please make them, remember your investors are older than you are in most cases. They don't read 7-point fonts well. But there's some basic things you need to do. An annual in-person or even Zoom meeting will go a long ways. And I think it's really worth doing. Sharice, I think if the next 2 pages are actually a sample, and I'm going to be sending you the deck right after this call, but this is a sample status report. People are like, well, what do I do? What should be in there? So I've given you just a framework for that. You want to go on down a couple slides? That's the rest of it. So here's the thing to remember. And by the way, we know you were pitching. We know you're emphasizing the positive and minimizing the negative when you're pitching. Totally get it. Most of us as investors have been in your chair. Going forward, all your projections with your investors need to be on a known pipeline. You need to share what's good and what's bad. All right. And, we can't help you if we don't know what's wrong or what's bugging you. I can't, there's no way for me to explain how valuable your investor pool can be to you. For those of you in the GIA, we mentioned Lana Fox. She has the most profoundly amazing, intelligent group of investors, and they have a diverse background. And there's a lot of cases where she doesn't even pay for consultants because she has investors that already know this stuff or own the consulting company in a couple of cases. So, and definitely no lying. It will kill you the next time you want to raise money because we learn we can't trust you. So just flat out don't do it. It will not work. Next slide. Oh, I could go on all day about this, but please ask for help. Don't be afraid to ask for help. We know it's not going to go right. We know things are going to go wrong. You're going to lose customers. Your CTO is going to quit on you. There's innumerable things that can go wrong in a startup, and every startup has them, right? You're not alone. So use their experience, leverage their network, ask for guidance, call them up if you need to. And they can oftentimes step inside. I'm an investor in a company right now where there was a huge problem in the team, and the CEO had to fire all 5 of the team members because the team had turned against him and wanted to run the company a different way. And it was bad what the team wanted to do, really bad. And it turned out that 2 of his investors had the ability to step in. One is a part-time CFO to completely redo the books for the last year because they'd been screwed up. And that's a mild way of putting it. And the other one could help them with hiring new people. And so he was able to really recover from what could have been a very catastrophic event simply by letting his investors and board members help him out. So next slide. Yeah, share bad news early. Okay, if something big's happen, get it out there. Don't wait. So I won't go through all of this, but it just is share bad news early and get it out there so people can help you. Your investors are the cheapest employees you will ever get. We work for you for free. We don't have our hand out asking for $200 an hour, right? And we have a stake in the company. If you go down, we go down with you, right? We all lose that together. So as much as it hurts to have to admit something really went wrong, admit it early because maybe we can help you fix it. Next slide. All right. This mine. Sharice, probably want me to do this one, huh?
Sure. This is just, we're essentially wrapping up at this point. So if you want to.
Yep. Okay, sorry. So we make all the content available online. And like I said, I'll be sending literally 5 minutes after we end, I'll send you the deck with the hot links in it. We will give you a survey. There are some areas, some people can reach out and you can help. They can help you. Unfortunately, I should have to take my name off this because I did retire about a month ago. If you've got a question, you want to send me an email, this email is still active and you're welcome to reach out. I'm happy to answer a few questions. Greater Des Moines Partnership will have a new person in my role very, very, very soon. Plains Angels is a local angel investor group. If you're in the local Des Moines area, there's some really helpful people in that group. And like I said, if there's something we can do to help, let us know. Any, I guess before we just shut this off, any final questions from anybody? Want to ask any other questions? Anything we didn't cover? We'd love to hear about it.
I think I'll ask a question.
Sure.
Yeah, so Demetrius Brown, Income Property Solution. And like Patrick, I actually got the notice seeing capital raise, so I didn't realize it was just text, so I apologize up front for that. But
Sure.
I am, a capital raiser myself. And the question I struggle with and have is protecting my investors, right, from the general partners. And sometimes I'll do a strategic alliance aside from my core group. And so I think about that. I spent a lot of years with my investors, and I kind of always get very curious on how to protect them from other general partners just taking my investors. And, when I'm syndicating and raising capital for other deals for commercial real estate.
Well, I'm not sure I have the knowledge of that commercial real estate space to answer that. It's my apologies, Sharice. I don't know if you or if there's something we can learn a little bit more about to help.
I would need a little more context. Actually, my first career was in commercial real estate, and I think some sense of the way that you structure the different entities is what I'm assuming. There's sometimes master entities, sub entities, who has access to what, who you're in your stance, sometimes banking or who's signing guarantees. Does it get down that route a little bit? And like what properties, what physical assets?
For us, we are exempt. So we're generally doing syndications, and we're doing a lot of the regulation D, 506B and boy. Even though I will be forming a fund of a fund that's going to be a semi-blind pool further down the line. That's basically the way it's structured. We work very closely with the SEC attorneys as well. And they kind of say that, there's not really too much you can do there. But I mean, I feel like, there should be something that you could do, like even if it's an agreement, just kind of figuring out if you guys, a lot of this is the same. So I just didn't know if you guys, have certain ideas or things that you guys do to hedge against that.
The only thing that comes to mind is, in the tech world is like who owns what IP or who owns what entity. And sometimes one company, actually, I think Mike and I are both investors in, they have thought long and hard about like the substructures, like what's the master corp and what's the sub corp and what's owned under each one. And to be frank, it becomes pretty complicated. I think that's where attorneys actually can provide you you want an attorney that's like a problem solving attorney, right? Like, here's the problem I'm trying to solve. What's the structure that you know of that best solves that? So there's that piece of it. And then just as the entrepreneur, I think, unfortunately, it's thinking about the ways that things can go wrong. And then how would you mitigate those risks on paper or not on paper, right? Like there's things that you can do outside of the legal realm to manage risk, relationships, et cetera. But you're in somewhat of a unique area, but I think it all comes back to the way that some of the legal stuff is structured.
Okay. Awesome. Thank you.
Any other questions when it comes to raising capital? Questions, comments, concerns?
Sharice, if you would go to the next slide. I just want to talk to the appendix that's in the document at the beginning. These are hot links to all the appendix items for pretty much the whole seminar. But there's some really great reading in here. And it's stuff that between Sharice, myself, and some others who've been doing this a long, long time, it's some of the best writing we've found. Most of these are fairly short documents. Sharice mentioned one early, what makes a deal investable. The lady who wrote that, it's one of the sharpest people I've ever met in my life. It's a couple pages. It is so relevant. So if you have the time, go through and do that. Back to questions.
Yeah, at the beginning of the presentation, you guys mentioned there are more than two philosophies, but one philosophy being raise only the money that you need and try to be lean and efficient. And then the other being raise all the money you need and don't spend your whole life fundraising, spend your life building. And so I'm curious about you guys' individual perceptions on those strategies, or if your own perception ends up being a combo of the two, or maybe it depends on the business. What are your thoughts on that?
It's a great question.
You go first, Sharice. You go first, Sharice.
Well, it's interesting. I've seen a lot of different things and experienced different things. at Dwala, we raised a lot of venture capital, right? And part of that was timing. We were in a hot market, we were hot space, et cetera. We could raise the money. There are some things that I think raising a lot of money, what I've learned is I would probably do it differently. We raised a lot of money in a point where I think, looking back, we weren't clear on product market fit. You can waste a lot of money, and your investors are asking you to accelerate, go, 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 go. And if you have money, you're kind of throwing it all around. And I think, like, if one of my investors were listening, it's not that they would disagree to that, right? You're trying a bunch of things and you have the money to try it to get there. But if it doesn't go well, you're not always in a good spot at the end of that. So if you're going to raise money, I would just really say, like, know how that money is going to be fuel, to put like gas on a fire, not fuel to get your car 200 miles down the road, right? Like, if you want to be raising a bunch of money, to me, it's like putting fuel on something that's going to just like exponentially grow. And I think there's a conservatism of like, you always feel this pressure of like, if I have an idea, is someone else going to do it? So there's like this speed component. There's a series of questions I think I would ask myself the next time I was in a raising capital seminar or the raising capital situation myself of, am I missing an opportunity if I don't take on more money and go fast, right? What if I actually go a little slower with less money? What's my risk? What's my risk there? And there's kind of like a risk reward. And there's an immense amount of pressure when you start to raise a lot of money, of how fast you can get to. And some of that pressure can really create a lot of stress on you as an entrepreneur, because there's certain things, no matter how smart you are, no matter how hard you work, that you just don't control. Customer adoption, sales, et cetera. Like, some of that you just don't control. And when you take on a lot of money, there's a pressure to get there.
Yeah, like pandemics.
You like pandemics?
I said no, and things happen like pandemics that you can't control. I mean, yeah. I agree with everything she said. And I don't even know if it's an addition, is I think that having a very specific plan of how you're going to use that money, and I think that I've also seen people raise a lot of money, burn through it, and to the point of they want to go faster, faster, faster. Your job is to make sure that the car can run, to use the analogy. If the car doesn't run down the road smooth and true and can't run down the highway, then you shouldn't pour more gas in the tank. And I think, I don't know the Dwala story personally, but I've seen other companies that spent a lot of money before the product was really ready for a customer to say yes to.
Then another small follow-up to that. So a lot of times, one of the biggest question marks about how much money I feel like I should be raising, it is around managing expectations and uncertainty around sales, especially in a B2B market where whether you do or don't make a sale in a certain time period can have a huge impact on the money that you do or don't need. So I know there's no magic bullet. No one has a crystal ball that knows exactly what's going to happen, but what are some smart ways that entrepreneurs can manage that uncertainty and make good capital decisions?
Well, I think the first thing I would say to you is you really got to be careful about it. When you're in a vertical market, you don't want to have 3 or 5 customers. You want to have 30 or 50. So one of the mistakes I see made constantly is going after the biggest customer in a vertical market. I absolutely don't believe in that. I don't think you should practice on your biggest customer. I think you go out and pick the 5 to 10 potential customers that are smaller, that if you lose them, it's not going to kill you. And by the way, they tend to be easier to close. So be selective and smart about who you go after. Trying to close Principal Financial Group's a nightmare. Trying to close a small 50-person company that has a 5-person management team, very straightforward. So I don't like to see a company that has over 20% of revenue with a single client. And sure, when you're talking client number 1, of course they're 100% of your revenue, but the whole idea is, can you leverage one to another? So Sales cycles are variable based on the size of the company in a vertical market. So just really, really think about, man, if I could get 5 small wins, think about the credibility that gives you, and think about the lowering of risk that happens, because if any one of them walks away, you're not losing more than 20% of your revenue. So that would be my first thought. Especially vertical markets are so different than, oh, I'm going after the consumer market, I'm trying to get all the kids on my new platform kind of thing. Totally different game.
I think what came to mind for me is one of the biggest expenses you can manage is people, right? Like overhead is a big part of this. And I think one of the early mistakes I see is entrepreneurs making the wrong decisions around how they hire sales teams and when to hire sales teams. And I could speak out of both sides of my mouth, right? As the founder, you're often the best salesperson, and you're often going to perform better than any salesperson you hire in those early days, because you can make decisions that a salesperson just can't, right? You know the vertical probably better than anyone. You know the product better than anyone. You frankly are motivated more than anyone. And so there's this willingness. I think there's this urge to be like, I need to go hire my like head of sales and like give that to them. And if your company is not ready yet, like that can be one of the biggest mistakes you make, right? Like offloading sales to someone else. The part that I'm going to speak out of the side of my mouth is some people are awful salespeople, right? Like I've seen some founders where I'm like, the first hire they need to hire is a co-founder who can sell, because they should not be in front of customers. So maybe it's like, know yourself. Are you that truly awful person, like salesperson who should not be talking to customers? You probably know if I'm talking to you. If not, if you're doing okay at it and you're having good conversations and making some progress, you're probably the best person to getting sales, to a certain point, and not assuming you're just going to hire someone and that problem's going to be solved by someone else. Because it's a tricky problem to solve early on in a startup's life. And if you start to bring on its salespeople too early and they don't actually know how to do that in an early company, and like all the structure isn't there and all the materials aren't there and the product's not perfectly there for them to sell, they're probably going to fail. So.
Yeah, and I can add one thing to that. On that subject specifically, it's a huge area. One of the marks of a company that can grow and grow quickly is that they have a sales process that is repeatable and that can be implemented by the average salesperson, not the star. Okay, sure, you're the star, Linda, Joshua, Sabath, any of you probably are great at selling your product, but you only get scalable when you can hire average salespeople who are motivated and are trained to go out and be effective and be cash flow positive and adding those deals to your business.
Yeah, I think the rule too I had for sales is like, get to the point where it's uncomfortable, right? Get to the point where like someone in your organization is almost doing that job full time. I think there's a desire to not look bad to companies, and you have to be mindful of that, but you don't have the budget to pre-hire people often, early on in a startup. So you'll know when you have to make that hire, which helps, manage cash flow. Any other questions? I appreciate all the engagement, everyone. Hopefully this module 1 gives you some place to start. Again, if some of this might have been completely over your head and others of it just seems very common sense. I think looking back, most of it's common sense, but I never kind of had it all in a framework for me. When I was putting this together, that's what I was trying to create. So like none of it should really be rocket science, but hopefully seeing kind of the full picture of it before you've gone through it will be helpful as you're navigating the ups and downs and twists and turns.
Yeah, I just passed on my thank you to all of you for attending, and don't hesitate to reach out if we can help.
All right. Good luck, everyone. Take care, and maybe we'll see you in the coming workshops.
Yeah, thanks, guys.
Take care, everybody.
Thanks, guys. Take care.
Thank you.
Have a great day. Bye-bye.